Heading into the second quarter earnings season, many analysts were suggesting that any beats would be met with a more muted reaction than last time out. And so far, they weren't wrong. JP Morgan strategists called the reaction worse than typical. Citigroup, Wells Fargo, and Tesla are just some examples of where beating on the bottom line saw shares tick lower. Our next guest says against an uncertain and confusing macro backdrop, investors would be best served by having a broad toolkit that is well diversified among strategies, products, and industries. Joining us now, Seema Shah, Principal Asset Management Chief Global Strategist. So, Seema, what's your read on what we have seen from earnings thus far?
Hi. Well, as you said, I think this earnings season has been fairly strong. You've had a number of beats, but we have to remember that actually coming into the season, there have been a lot of downgrades to the forecast. So the hurdle was fairly low. And I think that's one of the reasons why any company that is beating is not really being celebrated by the market, and any disappointments are really being penalized.
Is there an overwhelming theme of the earnings season? Resiliency was one of the words that we had continued to hear from analysts coming into the start of this season. Now that we're a few weeks in, is there one that's kind of reigning supreme?
Well, I think one of the interesting things for this earnings season is, despite a lot of, growing concerns about the economy, actually, the forward guidance doesn't really mention much concern from that perspective. It's quite optimistic commentary coming out from a lot of these companies, which, in one way, of course, it's very promising. But on the other hand, one of the concerns that many investors have is that there's a lot of complacency in the market. And that's also being added to by this current earnings season. And I think that's one of the reasons why any beats are not getting the same kind of very strong market reaction as usual, because there is concern about complacency.
And so what does one do in reaction to that? You talked about that broad toolkit. What does that mean exactly?
Well, as you said, look, the outlook is fairly unclear. There's a big divide, I think, amongst analysts on the street of whether we're looking at a soft landing, a recession, a no landing, kind of all of these terminologies out there. And with that uncertainty, it does make it quite difficult to have a very clear set for investment perspectives. In that environment, I think the best tool is always going to be diversification across asset classes, across regions. Within the fixed income space, obviously the core fixed income, really the cautious areas, but it's still giving you a bit of pickup. So that's the investment grade area, securitized debt. Those are going to perform well. Within equities, given there are some question marks around the US equity market and how much further it can rally from here, it probably makes sense to think about international markets. And from an international market perspective, thinking about which ones are going to be able to buy into some of these long-term themes that are starting to emerge. One of them, for example, being reshoring. And then finally, think about alternatives. That continues to be a really important part of the story. We at Principal Asset Management do think that inflation mitigation continues to be an important part of the portfolio. So from that perspective, thinking about things like infrastructure, which do give you that slight inflation defensiveness, does continue to be a really important part of any portfolio.
Within that broad toolkit as well, how should investors evaluate the state of the consumer right now?
So the consumer is undoubtedly very strong. A lot of the economic data just continues to show that strength, even relative to other sectors. We are a little bit skeptical of how long it can last, however. So on one hand, as we all know, that consumers have really been supported by this huge buildup in excess savings. That is now being wound down. And on some estimates, especially ones that are coming out from the San Francisco Fed, it does suggest that it could be entirely exhausted by the end of this year. So that's a really important support being taken away. And then there's a lot of the pandemic-related fiscal supports, additional ones that have also been protecting consumers and insulating them from monetary policy hikes. That is also starting to fade. So although consumers are very strong today, I guess I'm a little bit cautious of how long that can be sustained.
I feel like we've been cautious of that for a while, Seema. So is there going to be a catalyst, or is it just going to be sort of the gradual deterioration that is flagged by things like the wind down in net excess savings?
Well, you're right. This recession, everyone's been talking about it for months and months, if not quarters. In terms of what's going to be the trigger, I think it can actually be either or. So one of the things that we've generally expected, this is something that which essentially just fades out over time. Those support systems are fading by the end of Q4. They would have faded significantly further. So actually a lot of that economic backdrop has now weakened. On the other hand, once you start to think about earnings and a lot of the complacency, which we do think is built into the system today, that does mean that the market is quite vulnerable to any negative shock. I'll give you one example, which is at the moment with headline inflation in the US down to 3%, there is a general feeling that inflation is now has now been defeated and the Fed has won its task. However, when you start to think about a lot of the climate change issues that we're seeing, the recent spike in commodity prices, I don't think it goes too far to think that actually there could be a threat of a resurgence in inflation around the corner. So there is a lot of uncertainty out there. And that, again, is a reason to have some diversification within your portfolio, focusing on potential growth, but also protecting to the downside if that worst case scenario does come to fruition.